What you see in this chart on the left-hand side is the Fed balance sheet in terms of these bars on the chart, which show you the expansion in the Fed's balance sheet on an annual basis or actually quarterly basis, I think. And at the same time, I've put up Fed funds rate. So you see the financial crisis, 2008, 2009, huge increase in Fed balance sheet. That was the response to the crisis, and then the quantitative easing that took place after it. More of the quantitative easing into 2010, and then into 2012, and then into 2013. And then we were all supposed to believe that they were actually into a period of quantitative tapering. Can you see it on the chart? Actually, there is a wee bit of quantitative tapering as you look at the Fed funds rate going up after 2018. And then we had a crisis in 2019 in the repo market as that quantitative tapering took place. They just managed to get the Fed balance sheet down a few $1 billion from the trillions that it had expanded. But then they had another crisis, and they started easing again. There's actually a new paper published this month, actually now September, so last month, by Viral Acharya and Raghuram Rajan, two of the authors, which is looking at the liquidity dependence that's taken place in the global economy. And their subtitle is basically how reducing central bank balance sheets is going to be a tough task. Because what the paper actually finds is that quantitative easing didn't work the way that we were expecting it to work. Instead of the long-term investment opportunities that quantitative easing was supposed to fuel by lowering long-term interest rates, then resulting in long-term investments, actually banks just expanded their balance sheet, did what they usually do, shortened some of the liquidity elements in the balance sheet, and increased their lending, and quite often increased their lending to buy companies. And then when they started quantitative tapering, the banks continued. So what we've now discovered, which central bankers seem to be completely unaware of, maybe that's because most of them are, I'm afraid, academics, is that banks behave like banks throughout the cycle. When you encourage them to lend, they do it. When you lower interest rates to zero, they'll lend, and they'll lend to anybody. They won't take any notice of whether or not the companies can repay, because of course, with almost zero interest rates, most companies can at least service their debt. But when quantitative tapering takes place, they continue to do the same thing. They don't taper. So what this paper is basically saying is that quantitative easing has been a failure, and quantitative tapering is an even bigger failure, because it produces crises very quickly in the financial system. But that's not the end of the story, because look what happened when COVID came along. The quantitative easing of past Fed maneuvers was like nothing to the response to COVID. Fed balance sheet expanded by more than $2 trillion, and all of it went to government spending. So you can see in the second chart there, fiscal balances. And I've put in red what happened in 2020, because it's very different. A lot of the quantitative easing that had taken place in the early parts of the global financial crisis went into the financial system and then went into asset prices. It didn't get into the real economy. This time round, governments got the money. Always a bad idea. And when governments got the money, they gave it out to everyone. They produced a huge demand response, which is fine. That kept the system going. It's just that huge demand response also produced a huge inflation response this time at the CPI level, not the asset price level, although that happened as well. George Shackle, who was an economist when I was at university. Whoop. At some point we'll get it right. Had this quote to make about prices and inflation. And it sounds very trite and not really very meaningful, that every price is involved in all prices, and all prices are involved in every price. But what that actually should be telling you, and the insight that it gives you, is that we're far from the